Good evening, beginning options subscribers. This is Scott Gillum with your beginning options lesson number 2, option valuations. We're going to understand how the option pricing happens. Before I begin, let me remind everybody all rights are reserved and copyrighted 2022 for ShadowTrader. That means the content in this presentation is presented for educational purposes only. It should not be considered as a recommendation to buy or sell a security. Therefore, the information in no way should be considered investment advice. Trading options involves risk and may not be suitable for all investors. All rights and obligations of the options instrument should be fully understood by you, the individual investor, before entering any trade. All right, for this lesson, we're going to talk about understanding the options chain, a little bit of a review, bid-ask pricing, how that's determined, the determinants for that option price that you see on the screen or the chart. We'll talk about two different types of properties of options, one called intrinsic, the other called extrinsic, and then a bonus slide at the end, kind of my take on what is a good option chain and what is a bad option chain. So let's begin. All right, this is a bit of a review. This is what an option chain looks like on the Thinkorswim platform. This is how it is displayed typically. We've got calls on the left side. We've got puts on the right side. We've got in the middle date. Here, this is the expiration date, the date when that option that you're looking at expires. We've got the strike price, or the price to buy or sell the underlying at. Then we've got what's called an ask price and bid price and ask price, one for calls, one for puts. Think of the ask as the retail price, think of the bid as the wholesale price. Also, we have volume and open interest on both sides. Volume meaning the number of transactions that happened during the day. That's not contracts. That's how many transactions happened. Remember, a transaction is a buyer and a seller that come together and produce a number. The open interest, how many contracts of a specific underlying at a specific expiration and strike are still open and available to be exercised or assigned. Now, taking a look at what these option prices are, if we take a look at the ask or the bid price, certain things determine the price of those options. Typically, it is market pressure based upon, 1, the strike price that you're looking at, 2, the price of the underlying equity, 3, the time to expiration. Those are the 3 main items that are going to give you a price for the option. Now, we also have to look at what is the expected movement between today and the expiration. This is called implied volatility. That's the expected move that the underlying could do between now and expiration. Of late, we haven't used interest rates affecting the price, but those possibly may come into effect as the Fed raises rates. And then we also have to look at the dividends that the underlying may offer in the time frame from today to expiration. So these 6 items all go into the option valuation that you see on your chart. Now, what determines this value? Well, if we take a look at stock price, and we need to figure out, well, the stock is at 100. Well, what's it going to be priced at? That's the option going to be priced at. at 101. That extra mathematical calculation is called delta. It's the Greek used for telling us how much the option price will increase or decrease on a $1 change in the underlying equity. Well, equities don't just change by a buck. So we've got another Greek, which is the first derivative of delta, that tells me how much this option will change from a $1 to a $2, or the next dollar of change of the underlying. This gamma is going to tell me what the new delta will be, which will tell me what the new option price will be. Then we have to know how much time is elapsing from today to tomorrow. How much is my option going to degrade in valuation between today and tomorrow? That's the Greek or the math that we use called theta. Implied volatility. That goes up and down. That determines how much more extrinsic value, I'll get to that term in just a second, is pumped in or pulled out of the option price. That Greek is called vega, and that's another mathematical input to the option valuation. Interest rate is done with the calculation of a Greek called rho. So, the option pricing. We've got two components for this option price. We've got what's called intrinsic, or the amount that the option is in the money. As you remember from lesson number 1, in the money means my option has a strike price that is less than the underlying equity if it's a call, or more than the underlying equity if it's a put. But there is also another component to that option pricing, and that's called extrinsic value. This is the anticipated or the pumped up value of the option, because it doesn't expire at the end of the day, typically. So it's got time. That adds more value. It's got implied volatility. It could move around a lot or a little. That also adds value. So the extrinsic value part of the option price is everything greater than its intrinsic value. Intrinsic, hard value. Extrinsic, air that's pumped into the balloon. Just remember it that way. Okay. How do we determine the intrinsic value? Well, you take the option price, and you can find that by adding the intrinsic plus the extrinsic value. Or, let's do it the other way. Extrinsic value equals the option price minus the hard or intrinsic value. I've just rearranged the calculation. Okay, intrinsic value. How is that figured? Simply a mathematical calculation. Two things impact intrinsic value: the stock price and the strike that you're using. So, intrinsic, stock price and strike only determine that. Strike, stock price. Out of the money options have no intrinsic value. That means that your strike price doesn't give you any hard valuation when compared to the stock price. In the money options, the intrinsic value is the difference between the strike and the stock price. There's your calculation. All right. The other part of the option price is called extrinsic value. All right, extrinsic value. Also determined by strike, also determined by stock price, but we pull in this time to expiration as an added component. We pull in the implied volatility as a component. We pull in the effective interest rate as a component. And we pull in the dividend as an input to this extrinsic component. Implied volatility is the biggest driver for extrinsic price. So what is extrinsic value? It is any other value in the options price above and beyond the intrinsic value. So again, extrinsic value equals option price minus intrinsic value. This is the portion of the options premium that increases or decreases due to volatility, time, and market risk. What is market risk? Well, it's the risk of loss based upon the potential price being changed on that underlying as we go in on time, day after day after day. Volatility goes up or down, or the price of the underlying changes to the point where I lose value. So let's focus on this extrinsic value. Where does it come from? How is it created? The amount of extrinsic value is determined by supply and demand. If somebody wants to buy more of a certain option, then there's going to be more demand. As supply is unlimited here on options, more demand is going to demand or deem that the price is going to go up to buy. Market participants are going to determine the price of the options through a bid and ask or an auction. I want to buy for X. You want to sell for Y. We're too far apart. So I've got to drop my ask price. You've got to up your bid price. That type of auction situation is what options pricing is all about. The overall market nervousness can also exacerbate the bid and ask prices of options. How do we measure implied volatility? That's the portion that determines that extrinsic, the major part of that extrinsic value. Well, we use what's called an option pricing formula. It's also called the Black-Scholes model. And this is what it looks like. Okay. Stop right now. It's not complicated. Yes, it's got a lot of those crazy symbols. But let's go through it. We've got call pricing or put pricing, depending on what you're using. We've got an equity price. We've got what's called the normal distribution curve or log normal distribution, a standard deviation. We have the strike price. That's where we want to buy or sell it at. We have the risk-free interest rate. We know that. We can look that up in a chart. We have time to expiration. That's on a calendar. Today versus the end of the week or next week or whatever. So all we have to really do is solve for this little guy right here at the bottom, this implied volatility. So let's run through this. All right. What do we know? Put and call price is on the chain, the option chain. Bingo. Get rid of that. Our equity price. Well, we know what that's trading on because we can look it up on a quote. Normal distribution, this is just math. You just plug in a formula. The strike, this is the area or the option that we're looking at. The 180, the 190, the 200, the 220, whatever it is. We pick the strike. Okay? Now, risk-free interest rate. We get that out of another, well, all you have to do is just look at the web or any sort of document. It will tell you what the risk-free interest rate. This is basically prime rate. Time. All we have to do is look at a calendar. We've got 5 days. We've got 7 days. We've got 350 days. So, now that we've taken care of either a call or a put from the option chain, that price, the equities price from a quote, normal distribution, mathematical function, strike price, that's what we want to use, risk-free interest rate from a chart or from another source, time to expiration from a calendar, we now can find this implied volatility factor to plug into our option pricing. So we just solve for it. All right. What is implied volatility? Remember the first word, implied, expected, where it will be in the future. Folks, this is your crystal ball for giving you some sort of insight as to how much the underlying equity could move between today and the expiration of that option. So, the IV, implied volatility, as we use it, market's expectation of the future price behavior of the equity for the life of the option being considered for an at-the-money valuation. So it goes from here to there, and the equity becomes an at-the-money evaluation to the strike that we're looking at. Implied volatility can impact only one portion of the option's pricing. That's the pumped in value. That's the value that rises or falls with market risk, that rises, typically falls, with time eroding, and can rise or fall with the underlying equities price movement. It is not concerned with intrinsic value. If implied volatility increases, it indicates the market expects the equity to become more volatile, have bigger swings, affects both puts and calls, not equally but similarly. If the volatility decreases, that means that the markets are expecting the equity to be less volatile, less of a range of high and low. Equities do not have implied volatility. Only options have implied volatility. Each and every option has its own implied volatility. Each and every strike has its own implied volatility. Each and every expiration and strike have their own implied volatility. Here's a look at a stock trading at 1843. Happens to be Amazon at a time pass. If we take a look at the 1845 option, all right, I own the 1845 option. Do I have any intrinsic value? Nope, I don't. I have an 1845 strike, stock's trading at 1843. I'm $7 from being equal. So the blue portion here is the intrinsic value. Bear with me. Stocks trading 1843. I own an 1830 option. I have intrinsic or hard value of $13.06. There you go. I own an 1835 option, call side. I have intrinsic value of approximately $8. There you go. But wait a minute, that option is priced, that 1835 option is priced around $22. I've got $8 of intrinsic. That means that I've got $12 of extrinsic. Yes, this extrinsic is based upon time to expiration, based upon volatility, based upon market pressures. Now, extrinsic value, just talked about that. Where is it the greatest? Well, extrinsic value, this is the plot of what extrinsic value looks like. And if we look at an options chain and we look at the underlying at about the same price on a strike versus underlying price, we find that extrinsic value is the greatest when they are nearly the same or at the money. Why? Well, that's because there is a greater potential for the equity to move this way or this way on this option at this strike being at the money. Therefore, I'm going to charge or have to pay up or can sell at the greatest expanded value of any of the other option strikes because it has a higher potential, the underlying that is, for moving away from this at the money situation. So the peak on extrinsic value is at the money. So when implied volatility is high, there's more extrinsic value because significant movement by that underlying equity is expected. Therefore, you have to pay up. It's like buying insurance, hurricane insurance, when the hurricane is at your front door. You're going to have it more expensive to buy that insurance when the hurricane is at your doorstep than if you were to buy it 2, 3, 4, 5 months or years earlier. Then when implied volatility is low, there's less extrinsic value associated with the options price because there is little expected movement by the underlying equity. All right. If I have a house in Florida, hurricane insurance is expected to be high because there's a higher probability of it hitting my house. If I own a house in middle Minnesota and I'm a fool to buy hurricane insurance, my premium's not going to be as much. There's little chance that I'll have a hurricane hit my house. Kind of an extreme, but there you go. Let's go back to what affects this implied volatility. Earnings announcements. What is unknown becomes known. Traders don't like unknowns, so they pump up the extra value that they want to get because of this unknown event called earnings. Takeover rumors. Price of something's got to be worth more on a takeover, right? Implied volatility goes up. Downgrades and upgrades. The ability for the equity to make or not make the price targets. Uncertainty in the market. Folks, it's all about news. It's all about something being unexpected that's going to change implied volatility. All right. So that ends the slides on option pricing. Just remember, option pricing is an auction type of market. I'll buy it here. You'll sell it to me there? Well, maybe we're not at the same level. So it's a bid and ask. I'll bid this, you'll ask that. I'll change my bid, you might change your ask. It's an auction market. So what makes a good option chain? Here you go. Simple calculation. Look at a 30-day from today at the money option. Write down the bid price, write down the ask price, and subtract them. That gives you the spread, the difference between the bid and ask. Now divide that spread, that number, by the bid side, the lower price. Gives you a fraction. Well, just multiply it by 100. Gives you a percent. If it falls between 1 and 2%, that's a very good option chain. That means that what you have to buy it for, if you made a mistake and turn around and sell it right away, you don't get a big hit. If it's 2 to 5% differential, so if that bid-ask spread is 2 to 5%, it's still a good one. It's usable. You can deal with it. You can make money on it. If the differential goes from 5 to 10%, it's in the caution zone. Proceed with care. Make sure that you have good expectations for where your underlying could go to make your spread or your option worthwhile. If it's greater than 10% on the bid-ask spread, my suggestion, look for another equity to use. It's not worth using that equity. All right, folks, that ends our discussion on option pricing. Have a great rest of your day. Bye-bye.